So I think the most dangerous one is the 4% rule, I think, right? So, and I have less of a problem with the 4% than the word rule, right? Because there is so much idiosyncrasy, so many different parameters and constraints and strengths and weaknesses that different people have. And then also across time, right? We can't have the same withdrawal rate across time. Right. So just to give you a few examples, right? So the idiosyncratic factors, right? It depends how much you want to withdraw. It depends. Well, what's your age? What's your horizon? Do you want to deplete your money? Do you want to leave a significant inheritance? Do you face any other cash flow constraints, right? Do you think you're going to have to spend time in a nursing home when you're older in retired life? And then also, so basically market parameters, right? So right now, as we are recording this, S&P 500 is at 6,600 points. The price earnings ratios, no matter what you look at, is the PE forward, PE backward looking, Shiller Cape. Everything looks wildly overvalued for the stock market. So the market valuations are extremely highly correlated with some of the retirement risk that you're going to face, right? You have a higher risk of running out of money if you're retiring at the top of a bull market than if you're retiring in, I say, March 2009 or June 1932, if we could go that far back. So market parameters and personal parameters, right? They have such a huge impact on what should be your safe withdrawal rate. And then some people obviously then also say, well, if it's 3% or 4% or 5%, well, it's only a percent difference, right? Of course it's not, because say you have $1 million portfolio, going from $30,000 to $40,000 is not a 1% difference, right? It's a 33% increase, or
a big difference. Yeah.
Or going from 40 to 50, that's a 25% difference, right? The percentage point in your withdrawal rate, that's the percentage of your nest egg, of your corpus. But even small percentage changes in that safe withdrawal rate make huge impact on your retirement budget. And then you multiply that, right? So you imagine you don't have 1 million, you have $4 million. And then you look at some of the ranges of retirement budgets that you would get at 3, 4, 5, or 6%. This basically you could drive a truck through that range. There's a very large range, and is basically the difference between a very high end retirement and a very modest retirement. So it's really useful to look at some of your personal parameters and constraints, and then also at market conditions when you retire. And I mean, so right now, obviously, I would probably be a little bit more cautious, right? Because today's market condition definitely looks exactly like something like we saw in 1929 or in 2000, and maybe tread a little bit more cautiously. At the same time, I mean, bond yields are definitely now much better than they were just right around the time when I retired, right? When bond yields were in the 1% to 2% range. So that would be very unhelpful. But so now you have a little bit better conditions there. And then on top of that, right? I mean, are you an extremely early retiree? And by the way, you are still an early retiree if you retire in your mid-50s, right? That's still by the norms of American personal finance standards. That's extremely early. In the FIRE community, it looks like everybody tries to outdo each other. And so somebody retired at age 30, and then now people want to retire in their 20s. But these are really exceptions, not the norm, right? And so normally, if you do retire that early, say at age 30, right, you probably, with this, say, 60-year retirement horizon, you probably shouldn't do a 4% rate. You maybe scale that down a little bit. But most retirees, say, who pull the plug in the 40s or 50s, or even late 50s, you have these special situations where, well, you have your Social Security right around the corner, right? You have pensions around the corner. You might do a downsizing of the home. So, and instead of having this traditional retirement, right, where you retire and then Social Security and your withdrawals, everything starts at the same time. You have a very different situation. You have basically a multi-stage retirement, right? So you have the stage between your retirement and when Social Security kicks in, where you have to withdraw a little bit more. And then once Social Security kicks in, you can reduce your withdrawals. And so how do you factor that in? So I've done a lot of case studies where people who are a little bit older, still early retirees, but a little bit older, I mean, they could have done something like a 5.5% or even 6% withdrawal rate, because once you factor in, two high earners, they have contributed a lot into Social Security, get close to the maximum benefits, both of them. So they can withdraw a little bit more initially, and then maybe 5, 10, 12 years into retirement, it's when your Social Security kicks in, and then you can lower your withdrawals again. And then even if you deplete your portfolio a little bit, at that point, hopefully your portfolio should then recover again and build enough of a reserve if you want to leave anything to your heirs. And so the 4% rule the 4% might be a pretty good starting point, right? If you're really far away from retirement and you say, well, I try to retire in 20 years, how much do I have to save today? And then you do some of these online calculators, and it gives you some advice on how much you have to set aside every month. And then then you can work with the 4% rule or 25x annual spending. But once you get closer to retirement, you probably want to do a bit of a more detailed analysis. And you want to check, because, and by the way, it can go both ways. And my experience is it actually goes more in the other way, where most normal early retirees, right, they can actually go higher than 4%, even if market conditions are a little bit scary and very lofty equity valuations. And the reason is always, well, you have some supplemental cash flows later in retirement once you work those in. And even if you give a little bit of a haircut to Social Security, because we don't know, are there going to be some benefit cuts at some point in the future? Might be, might be not. Even with that worked in already, normally you might actually get a higher than 4% withdrawal rate. And then on the other side, and the other end of the spectrum, you have these super early retirees, right, who are basically 40 years away from Social Security. So for them, these supplemental flows, they are probably, they're so far in the future. So net present value of that is essentially negligible. And you have a very long horizon, and it's very risky to retire so close or at the market peak. They probably want to do a little bit less, even though, of course, if you're really young, you could still also make the case, well, if things go sideways, you can always go back to work, right? And that's something you can factor in too, if you want.
Subscribe to Redefine Retirement on YouTube, Spotify, or wherever you listen to podcasts.